So my name is Gavin, as Keelan said. I've been working in Wayflyer for 4 years now. Worked in the kind of e-commerce space that we mentioned earlier on at the start, and now I've moved across to the B2B or the wholesale side of the business for the last 2 years. So I should be pretty well placed to answer questions and go through some things around the cash flow. But yeah, just before we jump off and jump into things, I want to go and give you a bit more context on this section here. So we're going to show you some real data of our customers. Some of it's good, some of it's not so good. So these are all real life examples. I've taken out all the names for obvious reasons, but this is the kind of best insight that I can give you. I haven't founded my own business. I don't have that side of experience. What I do have is experience in reviewing and analysing companies from a risk perspective. So that's what I'm going to show you is hopefully it'll add value for all of you. Also, just I know Keelan mentioned it, but it is mostly wholesale focused brands rather than e-com. So you'll see me talking about purchase orders, invoices. If you have omni-channel approach, it'll be relevant as well. So yeah, predominantly wholesale. And then yeah, finally, this is, as I said, from Wayflyer's perspective, from my perspective. So if some of it does seem out of touch or unrealistic, maybe based on assumptions that are purely financial based and not in the weeds, then I apologise, but I'll do my best. Great. So this is all about kind of early stage and launching up front. So what we see quite frequently is brands that start and they start huge. So they get a large PO and they don't really know how to deal with it and how to handle it. So the first thing you do, first of all, when you get a large invoice from a retailer is you have to celebrate it. You have to actually enjoy it because it's obviously a big boost. It's a big time for the company. It's a big, event. So celebrate it. But then you kind of have to ask yourself those two questions on the slide there. So can you fund it? And then can you fulfill it? Because if you think about it, funding a large PO like that will take you 4 or 5 months. It's going to take a while of cash outlay out of the bank. You have to purchase that stock up front in a large sum. That cash is going to be gone for 4 or 5 months. And if it's too big for the business in its early stages, then it's going to cause massive cash flow constraints. So if I have one piece of advice, it's start small, scale smart. You go back to the buyer, whoever you're discussing the invoice with, and say, listen, any chance we can start smaller? We don't want to launch in 500 doors tomorrow. We want to launch in 100, 200, and then work our way up. It'll allow you to scale and actually handle the finance side of the business as well. If you are able to fund it and fulfill it, fire away. I'm not going to stop you, but I just think that that's a better approach. Diversification. So you're going to hear this word a lot today, and it's actually something I was talking to a couple of you earlier on about. It's all about diversifying revenue away from 1 or 2 retailers and diversifying away from 1 or 2 suppliers. It's multifaceted. I actually had a lecturer, I did a master's in finance in Dublin. I had a lecturer called Martha who used to always say diversification is the only free lunch in finance. And I think that kind of rings true across the board. She was more talking about kind of portfolio theory and investment analysis, but it actually is true for any company. Diversifying is just how to reduce risk. So I think, as I said, supplier, retailer, and even product base as well. One common kind of pitfall, and I'll go through a couple of examples in a little while, is that diversification piece, and it's a big reason why companies may have defaulted or gone out of business. Like there's no contracts in the wholesale world, Like companies like Tesco and Sainsbury's, they don't sign contracts with small CPG brands. So you have to really make sure that you start small, diversify early. One more thing on this actually, sorry, before I move on, it's actually, not only does it reduce the risk, it also gives you a bit of a negotiation tactic as well. So if you are talking to 3, 4, 5 different retailers, you can bounce them off one another and be like, listen, I'm getting a better deal here. What can you do on price for me? You can actually talk to various ones and negotiate. So yeah, just try and work that way. It's much diversifying away from one retailer is so much better for you. Cash flow discipline, so the exciting stuff. Cash conversion cycle is incredibly important. And it's something that we see time and time again, the companies aren't managing it well. And you'll see here in the top left-hand side of the screen is actually a bank balance. So those spikes coming in are revenue and investment, and then the cash essentially disappears straight away because they have to spend it all straight away. So this company actually didn't qualify for funding as a result of this. They weren't managing a buffer in their account. They weren't, adamantly managing their cash conversion cycle. We spoke to them, they didn't even really know what it was in terms of timelines and certain retailers. So just knowing when exactly the cash outlay goes out of the bank and then when you start actually generating revenue for that cash is hugely important. It allows you to manage the kind of buffer in that middle period. And it's something that we see time and time again, like no matter what size the business is, they just don't manage it that well, and they end up with no cash. And I'm not sure if you can see, it's quite small, but I'll use the mouse. See this expense coming, this is a cash flow, by the way, this is ins and outs of the bank account. So that expense item down there, that's actually a bounced payment. So, you know, they're actually running so low, they're bouncing payments to HMRC. So yeah, just basically know your cash flow in and out, be very disciplined with it, and just constantly keep a buffer in the account at all times to fulfill small payments, you know, payroll, HMRC, whatever you guys are paying. Just manage that cash properly. And then in terms of like payment terms with suppliers and with retailers, over time, like obviously the early stages, you mightn't have the ability to negotiate and you mightn't have the buying power, but just constantly go back whenever you're putting in a large order to say, can we get better terms? Can we get X, Y, and Z? Just keep going back to them and keep asking, because it's going to really help. And it's what we found when we talk to customers. They say every time we buy a new PO, or every time we land a new deal or land a new invoice, they actually go and say, okay, give me 14 days rather than 30. And you know, they might settle somewhere in the middle, but that's where success really comes in, because cash is everything. I don't want to say cash is king, cash is queen. How about that? Then, in terms of protecting your own capital, so I actually haven't spoken to many of you today, but I'm sure some of you are quite early stage and are investing your own money in the business. Set a limit just from the outset, just be like, this is the max amount I'm going to put into the business. Something we see frequently is companies that are consistently getting personal cash injections into the bank. Yes, so be mindful of your personal financial risk and your exposure to the business. Set that limit early on. I don't want to be Mr. Negative, but it may never come back. Like some companies do fail, sorry to say it, it's just how it happens. So just set yourself a limit and don't go beyond it. And then in terms of external capital as well, so one thing that an early stage business should be looking at is their debt repayments as a percentage of monthly revenue. So how much money comes in, how much money goes out to debt. We usually say about 30% should be the maximum per month in terms of monthly repayments to a debt provider or a debt facility. And we won't usually provide funding to somebody who has that already in the business, because we don't want to over leverage them and actually negatively impact the cash flow as a result. So protect your capital from a personal perspective, but then also from an external perspective as well. Look at various financing providers, try and diversify risk from that side of things as well, not only from a supplier and a retailer perspective, but also from a financing provider. It's probably not something I should be saying as a financing provider, but just constantly be talking to other people and have various options on the table from an investment and a debt provider side of things. And then finally, just on this slide, going through like a due diligence process actually can be a positive for the company. It can show you where you're doing well and where you're doing badly. So don't be afraid to send some data to, I don't know, us or whoever debt provider you're looking for. We can tell you where you're going well and where you're going badly. As I said, I've probably reviewed over 1,000 CPG brands over the last couple of years. I know a thing or two, so we actually can give you some insights into what's good and what's bad. I have a little clip here to show you. I'm not sure if the sound will work, but hopefully it will. It's from a customer of ours, Acton, and the founder gives a bit of detail on what I'm talking about. So it's not just me you're hearing it from, it's actually from a live customer example.
Hi, I'm Colin Mackin, the co-founder of Acton, and here's my founder's formula. Sometimes the hardest decisions as a founder are the ones that seem like the biggest opportunities. But success isn't about what you say yes to, it's about having the courage to say no. For us, that moment came when we turned down Sephora. Now let me take you back, because it wasn't an easy decision. Like most beauty brands, we had always seen Sephora as a dream retailer. From the moment we started the brand, we believed Acton belonged there. It felt like the ultimate validation, the stamp of approval. It said, you've made it. We spent years building relationships, reaching out, having conversations, hoping for that right moment, and finally, after all of that persistence, we got an offer. For most brands, that's the dream, but here's the one that no one talks about. Offers come in all shapes and sizes, and ours just didn't feel right for us. We looked at it, we assessed it, we spoke to them, and it felt off. The terms weren't right for us and where we were. The positioning wasn't right. It felt rushed. I remember sitting down with Helen and having the conversation. Were we really going to walk away from Sephora? We wrestled with it. It wasn't just a business decision. This really came down to our character. This came down from two people that had come from Northern Ireland, came to the US and built a business, and now we were being too stubborn when a big opportunity presented us. It was tough. That was the hardest decisions we've ever made. Because as a founder, you're always told to seize the moment. Say yes to every opportunity, but no one tells you that not every opportunity is a yes. And this one, this wasn't. It was years before we heard anything. It was complete radio silence. And us, we went ahead. We had ups and downs in the business. Overall, it was the best thing for us. You know, we got to improve our products, improve our brand, and make those refinements that we knew we made. And maybe sometimes people won't tell you about those refinements, but in your gut, you know you need to make them. Now, fast forward 4 years later, that's exactly what happened. Sephora came back with a completely different offer. They saw us this time. It was a new relationship, a new Sephora, and a new activity. This time they wanted to launch us nationwide in 235 doors right across America, online, in-store, with a huge activation plan that involved activation in Times Square. We were blown away.
Acton is in Times Square today, guys. This is unreal. Look.
They got it, and we got them. It was incredible. And the reason I'm sharing this is because for every founder at some point you'll face a really tough decision. Many actually. And the moment that you have to choose between the easy win and the long-term vision. So here's what I've learned. If something doesn't feel right, trust your instinct. If an opportunity forces you to compromise on your core values, it's not the right one. If you're being pressured into saying yes because you might never come again, remind yourself that the right things always come back around. And saying no isn't closing a door, it's making space for something else. And when that door opens, you'll walk through it knowing that you've did it on your own terms. Today, Acton is nationwide with Sephora, doing incredibly well, building on strength to strength, and we've done it on our own terms, and we couldn't be happier.
But yeah, it's just a live example of a company that turned down a big PO up front. They decided to scale smart, and they've been very successful as a result of that. So over to a live customer example. So this is a UK bakery business. They launched pretty well with one major retailer in the UK, and then they collapsed because they relied so heavily on one PO from one retailer, and they weren't cash flow disciplined. So you can see the three things in the slide there. They didn't start slow. They went from basically 0 to 100K in a month. They didn't diversify. That's all from, it doesn't say it, but that's all from one retailer. And then also they basically had to pump all of their money into stock, and eventually couldn't actually even pay their wages. So that's the kind of three things that went wrong for them, and they ended up actually going into liquidation as a result. That was really doom and gloom, I'm sorry. Just to say, this is a good example of the three things that went badly for one customer. Then in terms of a delayed PO, so this is another customer, this is a beauty brand, and it was a customer we used to work with in 2024. That top graph there is their revenue for the 12 months, October 23 to October 24. You can see that big spike. That's the big PO they had. However, it was meant to land about 6 months prior to that. So they landed this large PO. It was going to be a third of their annual revenue. They were delighted. They pumped they actually took funding from us to fund it as well, which was all fine. And we ended up having to bridge them twice in the meantime. So we did kind of work through it with them because it was obviously an issue with the retailer. But they relied so heavily on that one PO that they were like, it got delayed by 6 weeks, and then it got delayed by another, I think, 3 months. So overall, it was about 4 or 5 months. So yeah, all of these spikes down the bottom in the bank balance side of things. So that spike there was our funding, that spike there was our funding, and then this eventual large spike was their purchase order landing in the bank about 6 months later. You can see here the bank balance dropped down over time, so they're basically taking funding from us and then using it on stock to purchase for that large PO, but we had to keep funding them. We also were happy to, because they did have that purchase order ready to go, so it was relatively low risk. It's just frustrating that it got delayed twice. So yeah, large PO, about a third of annual revenue. It's a bit too much. So a good example, how about that? Diversity works. So this is actually a US company. It was the best example I could find, but they're a canned beverage company in the US. You can see down the bottom is all of their different revenue streams. So they work with the likes of KeHE, ViStar, Shopify, UNFI, Amazon, Target, Safeway. They have loads of different retailers in the US. and they sell through those distributors as well. I know they aren't kind of a straight equivalent in the UK for the likes of UNFI and KE, and they also can be difficult to work with in terms of the disbursements they take. So there's other issues with them, but from a diversity side of things, they're actually really good, because not only do they distribute into large companies like Whole Foods and Sprouts, but they also distribute into smaller retailers too. So yeah, I think potentially like it's an issue working with retailers or working with distributors sometimes, but it also can give the benefit of that diversity. And that top graph there, that's their revenue growth for the 2 years to September or November 24, I should say. So this company actually stopped working with us because they got bought. Because of that revenue stream, they turned profitable, and the diversity in revenue was so strong that a larger CPG brand came in and bought them and kind of engulfed them into the business. We actually have another example of diversity, a live example. Dan here has his own company. He sells Amber Eyewear. It's an eyewear brand in Ireland, and they landed a large PO with Brown Thomas, who is the equivalent of Selfridges in Ireland. And what happened was they went really well. He thought it was all going well, and then they sent him back 1,500 pairs of glasses. So he was like, what am I supposed to do with these? They were the worst selling SKUs, and they sent them all back to him. But thanks to his own like diversity and things like that, he had another retailer lined up to take them all in, and he didn't actually lose that much money on them in the end. So even that small things like that, if something happens negatively, like you actually have an opportunity to sell it on elsewhere. Are you really making money? It's all about your margins, all about your gross margin, contribution margin, all about unit economics and paving that way to profitability. So we understand that early stage businesses aren't going to start printing money straight away. It's not in their nature. You're going to start burning cash early stage. That's fine. This is just kind of about how you pave the path towards that profitability and how you become more attractive to investors as well. I'm not sure if anyone watched that Beckham documentary, but I found this meme that it's an accounting joke, so I apologize, I'm an accountant. I found it quite funny, you guys might not, but here we go. Yeah, it didn't go down very well. Great. Moving swiftly on. So this is where it starts looking like an economics lecture. So this will be quick. Sorry about this. But you'd be shocked by the size of some of the brands that we talk to that have very little idea what their unit economics are actually, like what they're actually doing. So they haven't really put them together. They haven't really analysed them in as much detail as they should. Unit economics are hugely important. It's basically how much does it cost to sell one unit of your product, both from a variable side of things and a fixed side of things. So variable costs and fixed costs. That's that really boring graph on the right-hand side of the page. So if I had some advice on this side of things, it would be forget about your annual profit or loss and just focus on the unit economics in the early stages, and just make sure that you're not losing a lot of cash on your products early on, and then the rest of it will fall into place. So if your unit economics make financial sense, the P&L will fall into place, and you will become more attractive to investors as well over time. The main part of unit economics is your contribution margin. So contribution margin is, like, you should become obsessed with it. It's what investors focus on. It's like the core measure of future profit potential is your contribution margin. So it's the revenue minus cost of goods, minus marketing, freight, and all the other selling costs associated with the business. So like retailer broker fees and things like that, or what are they called? Not stocking fees, like wastage and things like that. Like before, like the retailer fees before they send the money to your bank. So yeah, investors focus on this. It's what they will see as a kind of a trend over time. It's what we analyze in our profit and loss as well. So I'll show you a couple of examples in a minute, but I'll look at a profit and loss over time. I'll look at the trend of the gross margin, the trend of the marketing spend, the trend of freight, and as the company grows, these should all be improving. They should all be getting better. They should all be giving you more space on that contribution margin and giving you a little bit more money to keep the lights on after those costs. So, as I mentioned, a positive and growing contribution margin is very attractive to us as debt investors, but it will also be hugely attractive to equity investors as well, because it's proof that your product works. It's proof that your product makes sense from a financial perspective. In the short term, it allows you to manage cash flow well. So you're not losing money on a variable cost basis, and then you have basically no expenses, no money to fulfill fixed expenses. But aside from that, in the long term, like that trend over time, like you'll never see me not provide funding to a company that's contribution margins trending positively over time. It's just incredibly attractive. So let's talk about a real life example. This is a UK health bar brand, and it's a company that we've worked with for a while. Firstly, like, you're going to look at the revenue at the top, the revenue growth over time, like 72% in 23 on 22, and then 88% in 24. So like, that trend is obviously incredible, and it's what's allowed them to unlock that contribution margin improvement. So if you look down to the second bold line there of contribution margin 3, that's 7% doubled to 14%, and then increased by another 4% to 18% in 2024. Ignoring everything else, if you just look at the bottom line then, like minus 45, so they're losing quite a bit of money early stages, which is fine because they were quite young in 2022. They've reduced that down in 23, and now they're actually minus 3%. We'd consider that nearly break even. And they've really done that over time through that unlock of contribution margin. The fixed costs remained pretty steady from 22 to 23. So they increased by about 10K or whatever it is. And then they jumped slightly in 24, but that's just the nature of the growth. And they still they still really improved that bottom line. Another thing I wanted to flag here is just going back to the point I touched on earlier on about constantly going back to your suppliers and, you know, talking to them about better terms and better margin and like things like bulk discounts. You can see that contribution margin, that gross margin rather, increasing over time. So it goes from 27 to 37 to 45. That's just economies of scale. That's them ordering more, kind of consolidating more in freight as well. So you can see that freight drops down slightly as a percentage of revenue, but they actually are able to, you know, go back to the retailers, go back to the suppliers, and order larger bulk discounts, larger whatever. You know what I mean? So yeah, those incremental improvements are what drives the improvement in bottom line, and it's really what you should be focusing on is that contribution side of things. So that's a food and bev brand, so that's a health bar brand in the UK. Like, depending on your product, your margins will differ, and this is just a bit of a snapshot as to what we see in our data. It's kind of an average of our industries in our book. So you have food and bev at about 30%, you have beauty at about 65%, and then you have apparel somewhere in the middle. The gross margin will dictate how you spend on marketing and you know, how much you can afford in terms of retailer fees and freight. Food and bev is usually sourced locally or sourced nearby, so their freight costs are usually much lower than, say, a beauty brand. They also usually don't have to spend that much as much on marketing. Sometimes they do have to spend a lot, but as much on marketing as a beauty brand because, you know, they're on shelves, people are in stores buying, and they're in that buying mode already. But if you're going to buy something in a beauty store, there's a lot more choice. You might be buying one item rather than a food shop and that kind of thing. It's just kind of consumer mindset more than anything. And then on the apparel side of things, that just falls somewhere in the middle. And it's like kind of a 50% gross margin, and you know, they have to spend on marketing, maybe not quite as much as beauty, but just contribution margin should be around 20%, give or take. As I mentioned, this example prior to that, you can see it was 7% early on, up to 14, then up to 18. So that's very healthy, and it's something that you should be focusing on, as I said. Pricing power. So higher costs are going to be inevitable in the early stages of a company. It's just how it is. You have to, you know, bow down to some of the suppliers. You have to kind of meet them at their needs. But as you continue to grow, just keep going back. And I'm going to reiterate this again. Just try and improve those terms incrementally and keep buying those bulk discounts and keep getting them better terms. And then in terms of supply chain, so like another unlock in that is the freight cost. So go like put your supply chain under a lens and just be like, listen, where can we make incremental improvements? Can we improve our packaging? Can we improve that margin by 1%? Can we consolidate goods and shipments into one and pay less to a freight provider? You know, just consistently think about how to always make 1%, 2% on that supply chain, because that will really unlock what sort of margin you generate overall. And there's another example here, which is the scaling and negotiating aspect. So as you can see, the gross margin, this is actually a US customer, it's a coffee brand. They initially started online and then they expanded into retail, which was that big revenue unlock up the top there. So they basically doubled in 24 and 23, and they actually tripled in 23 and 22. So that expansion into retail was really helpful for them. It allowed them to bring those freight costs down overall as well, because they were, as I said, consolidating those orders, paying more, but getting better margin on it as well. And then in terms of the gross margin, so just, bulk discounts. I feel like I'm just repeating myself, but it's important. And then actually these guys spent more on marketing, which is fine because you have a little bit more margin there to work with. So you can see that's increased to, you can't actually because there's a slit in the screen, but it's increased to 22% in 2024 because they have a little bit more room there to pump the revenue, and they have done that successfully as well. Okay, so this section is on forecasting, so planning the next 12 months. Obviously we touched on it earlier on. This is your session now. So it's all about building forecasts and the benefits of accurate forecasting, and kind of just keeping that future mindset in the business is really important, and it allows you to do various things that I'll go through now. So there's loads of benefits. These are just 4 that I've chosen, and I'll go through them individually, but the first one is the external aspect. So a lot of stakeholders that you'll be dealing with in terms of investors, debt providers, even retailers, they'll all ask you for forecasts. They'll all ask for 12 months cash flow forecast, or some sort of idea what the revenue is going to be like over the coming 12 months, how the cash flow is going to look over the coming 12 months. So it's, as I said, it's one of the 3 things we look for when we're reviewing a business is a cash flow forecast. Then in terms of flexibility, so like having a forecast that you're able to change, and kind of, I'll go through the scenarios in a minute, but it allows you to quickly adapt to any change in the business. And if something gets delayed or something has to be brought forward, a quick change in the forecast and like having that plan in place prior to that will give you a huge benefit, because you're not just reacting and trying to deal with problems as they come. You actually have a slight plan in place that you can then be flexible and dynamic and move towards. Then in terms of the aim, so it's like anything. If you give yourself a target, or you're training for a marathon, let's say, and you have something in the future, you have a target, you have something set in place, or even like a personal savings target, set yourself a goal, and that's what a forecast does. It provides direction, it makes you disciplined and accountable for that forecast as well. And then in terms of going back to the wholesale side of things, as I said, it takes 3 or 4 months of planning. Usually the cash conversion cycle is about 5 or 6 months. So therefore having a forecast is so important around planning when to buy that stock, when to send that order, when you need stock in the warehouse, all of that jazz. Every single timeline in a wholesale deal will be important from a forecasting perspective as well. In terms of actually building one, so I'll show you an example in a minute, but the 3 scenario approach is what we find works the best. So have one that's generous, have one that's a budget or worst case, and then a realistic one as well in the middle. So the best case is to ensure that you're able to adapt if the revenue does grow, and you're able to buy that stock up front, you're able to plan in advance, because if you're growing up into the right quickly, you'll need to know when to order those stock purchases. The worst case is just to basically, or the budget, let's say, so I don't want to say worst case. The worst case is to, I just said it again, is to ensure that you survive. So ensure that the business doesn't go under and the cash flow doesn't, run to zero, basically. So it's more about survival than growth. And then the realistic case is the kind of goal of the business. So it's the target, the actual forecast, let's say. So having those 3 forecasts allows you to balance optimism with realism. It allows you to survive and ensure the business doesn't go under in the next few months. And then it also allows kind of, I suppose the main thing for physical products is when you should buy stock or when you have to buy stock. And planning around your inventory runways, looking at your hopeful revenue growth over the coming 6 months, when you'll need stock for that purchase, for that PO, let's say. Then in terms of a rolling forecast, so 3 scenarios and then rolling forecast. So updating the forecast regularly, usually on a quarterly basis. You can do it monthly, but actually learning from the most recent months, because you're only really as good as your last month or your last quarter. So learning from that and then developing a better forecast, a more accurate forecast based on those most recent data points is huge. Because it'll if you got it way wrong, the forecast is going to be even worse in the next 3 months. So constantly changing it, constantly updating it, and yeah, I went through the benefits already, but just keep it accurate and keep it usable. Now, this is actually, Keelan touched on it earlier on in her segment, but this is actually Keelan's new brand. So it's the forecast she sent to me last week to have a quick look over. Big up to Keelan for starting her own company. Woo, well done. But yeah, she sent this over to me, and I knew she was serious about it beforehand, but when she sent this, I was like, wow, this is going to be good. It provides you with those 3 scenarios. So you see a lean, medium, and aggressive approach. I'll go through more screenshots. I couldn't share an Excel spreadsheet, but actually I probably can. Great, so this is it. So you see that lean, medium, and aggressive forecast. There's 3 different options. You have all the inputs that go into it. You have the unit prices, so that's an average kind of order value. You have the kind of COGS per unit thereabouts. All the upfront costs. So this is launching right now. I think it's October is going to be the launch. Yeah. So this is right now, and it shows you like how much money it costs to actually produce a good, and it gives you the various options in terms of how much marketing they're going to spend, how much growth they're going to drive. Go into the individual ones then, and you can see that they're broken down by month, which is hugely important. So October 25 this month, the actual selling units, the revenue, all that jazz, and you can see things like OPEX, and like it's a really detailed forecast, and it's obviously embedded with good assumptions and accurate assumptions. And then if you go to the medium, I'll just go through them individually briefly. Again, higher growth, and it will all be about when to buy more stock. So if you think about it, they've invested, I think, I don't want to give any figures, but they've invested money into the business to buy stock up front. And they have a certain runway in the business right now, but it's all about planning when Keelan needs to buy her next inventory run, when she needs to put more cash out of the bank. So yeah, having this and having the units sold is hugely important. And that's the aggressive one. Again, I'm not going to go through it in too much detail, but just having those 3, so that say like if the launch goes really well and they start selling thousands of products straight away, she'll need to buy stock straight away. So just having that kind of 3 scenario approach is really good there as well. Finally, just the overhead kind of breakdown and projections. So this would be like, what the actual drivers of the fixed costs are as well. I can probably share kind of a template of this afterwards. I'll remove, so I don't know, I actually haven't asked Keelan if that's possible yet. But I can share a template of this so you guys can use it, because I think it's one of the best forecasts I've seen. So yeah, it's just basically a breakdown of all the figures and the 3 scenario approach as well.